tax planning idea. All right, they're a corporate income tax. They are imposed by governments. So, for example, you could go to Malaysia, and if you are an insurance business and you're a foreign company, they'll charge you 5% more than if you're a domestic company. If you go to India and you're a foreign company, you're going to pay 10% more than if you're a domestic company. Okay? These are different strategies that different governments have actually imposed on foreign multinationals. Even China has withholding tax on services fees that are charged by Hong Kong companies and other companies outside of China. Okay, but more about that in weeks to come. We hope to get another consultant to talk about that in time. Okay, what I want to share with you when I get straight to the fact that tax havens, although the Common Reporting Standard is trying to stop all this, they still do exist, and you just need to know when you're in one what you can do and what you should not do. Okay? And how many of you know what a tax haven is? Do you know what a tax haven is? So is Hong Kong a tax haven? Because it has a very low tax rate? It depends, right? So there's a bit of grey area. What's a tax haven, what's not? Up until 18 months ago, Hong Kong was a tax haven, and now it's started to join the OECD through FATCA and now the Common Reporting Standard, and so then Hong Kong gets removed from tax haven status. Okay? All right? And Singapore was a tax haven for a while, but now that is moving away from tax haven status. Okay? But then again, different countries have different rules. The USA have its own rules for what is a tax haven, what is not. And it's a little bit different from what OECD countries agree to what a tax haven is and what it is not. Okay, so we're going to get on to that. And it matters if you're in a tax haven. Why? Because if you're dealing with if you're a US company and you have a subsidiary in a tax haven, then you don't get the benefit of tax credits. But if your subsidiary is not in a tax haven, then you get the benefit of tax credits. You see? So one thing knowing what tax haven is, but you need to know what is the benefit of not being in a tax haven. Does it mean you're just going to pay more tax? Not necessarily if you structure things correctly. Because you structure things so you get the tax credits even though you're paying more tax. Yeah, all right. So we've got withholding taxes on dividends, other amounts paid to foreign citizens. Yes, foreign citizens. All right. Okay, so what do we mean by a tax haven? Well, maybe we could call Singapore a tax haven. Okay, but what I want to show you here is that some of the other countries here, we actually showed you Malaysia, Singapore 17%, Switzerland 21%, China 25% and 16.5%. What's important here is that these income rates don't tell the full picture, okay? Because this Switzerland amount is, if you actually, the tax rate in Switzerland, I think it's less than 10% around, but in Zurich, the canon of Zurich has its own 12%, you add that up and you get 21%. So if you go to Iowa in the USA, they've got their own state tax that actually adds on to the total tax for the whole federal system of the United States. All right, China has a lot of VAT taxes and other taxes that make its effective rate greater than 50%. Hong Kong, no VAT is good, but 16.5%. All right, so you can see that there's a lot of different tax rates throughout the world, and thank our lucky stars that we have variation, because that allows us to do tax planning. If we didn't have variation, we cannot plan. You see, the idea of tax planning is to minimize legally your tax that you pay as a corporation. We were talking about corporation now. We're not talking about individual. Last week was about individuals. Now we're talking about corporation planning, okay? All right, so variation gives you tax planning opportunities.